Welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and in today's episode, we're diving into the deep end of digital options trading. Now, if you're still looking at digital options as a simple yes or no, call or put type of bet, you're leaving serious profits and serious risk management on the table. Because here's the truth, digital options have evolved. The traders who are thriving in 2025 aren't just guessing direction. They're strategizing, they're hedging, they're leveraging expiries and straddle setups and pairing their trades with spot FX or even commodities exposure. That's what separates consistent traders from those just tossing coins and hoping for the best. So today we're unpacking the smarter ways to approach digital options. Whether you're navigating high volatility events, building in layered expiry structures, or protecting your capital through hedging, this episode is for you. Let's start with the challenge itself. Now, the structure of digital options is deceptively simple. You're predicting whether a price will finish higher or lower than a certain level by a set expiration time. If you're right, you get a fixed payout. If you're wrong, you lose your stake. Sounds clean, right? But the reality is, this format is incredibly unforgiving. You could be right about the direction, wrong on timing, and still walk away with nothing. That's what makes strategy essential. And that's why experienced traders approach digital options with layered thinking. Especially in the current macro environment where we've seen heightened volatility from things like the Fed's unexpected dovish pivot, rate cuts in the Eurozone, and geopolitical pressures coming out of the Red Sea shipping disruptions, precision is more critical than ever. Let's talk about hedging. Now I know the word hedging tends to scare off newer traders. It sounds technical, complicated, but in digital options, it might just be your best friend. Because when you're trading in a market that can whipsaw on a single tweet, or these days, an AI-generated deepfake, it's reckless not to have some protection built in. There are a few ways traders hedge digital options. One of the more common tactics is taking opposing digital positions, same asset, different strike prices, or expiries. Say you're trading euro to US dollar, and you buy a call at 1.1050 because you're bullish on euro strength following a weaker than expected U.S.jobs report. But to hedge that directional bet, you also take a put option slightly higher, say at 1.1070. That way, if the pair spikes up and then reverses before expiry, one of those positions may still end in the money, or at the very least, help soften the blow. Another method, one that's gained popularity lately, is pairing digital options with a traditional FX spot trade. Let's say you go long on a digital call option for pound sterling to US dollar. At the same time, you open a short position in the spot market. If the market moves against your digital trade, the spot position can help offset that loss. It's not perfect, but it gives you a way to stay in the game while protecting your capital. We're also seeing increased use of ladder-style setups, especially from traders operating around major event risk. The Bank of England surprise hold earlier this month? That was a prime example. Traders layered call options at three levels, 1.2450, 1.2475, and 1.2500. The price moved sharply after the announcement, reaching the middle level before fading. In that scenario, the lower ladder contracts paid out. The higher ones expired worthless, but the loss was mitigated by the earlier gains. That's the essence of risk-managed digital options trading. You're never placing all your chips on one outcome. You're structuring exposure across potential moves. Now, let's shift to the straddle strategy, because this is a big one, especially for those of you who trade economic news events. With straddles, you're buying both a call and a put on the same asset, at the same strike price, with the same expiry. Why? Because you're not trying to predict direction, you're betting on movement. That's key during high volatility moments like CPI releases, central bank rate decisions, or big geopolitical headlines. Take last week's US inflation data. Markets were on edge. No one quite knew whether inflation was moderating enough to justify the Fed's dovish shift. Traders loaded up on straddles in euro to US dollar, expecting volatility but not confident in direction. When the CPI came in cooler than expected, the dollar tanked, and the put leg of that straddle paid out beautifully. But here's where the pros separate themselves. Some use double expiries. That's right. One leg expired 5 minutes after the news drop. The other had a 15-minute expiry. That second expiry allowed them to capture the full directional move as markets digested the data. The first leg caught the knee-jerk reaction. The second, it rode the trend. Two expiries, same event, smarter coverage. That's a tactic we're seeing more of, and it works especially well during events with delayed market reactions, like central bank press conferences that follow the rate decision. And don't forget, reversals happen too. If the initial market reaction spikes upward but price starts to retrace, traders are now adjusting their straddles mid-flight, closing the call leg early and letting the put run. You don't have to sit there and take a full loss on one side. If you're nimble, you adapt. Now, let's talk about expiry selection. Because let's be honest, most traders fail in digital options not because they got the direction wrong, but because they got the timing wrong. And in this market, timing is everything. Short-term traders might gravitate towards 60-second or 5-minute expiries because they're fast, adrenaline-filled, and feel like action. But unless you have precision timing or inside info, they're dangerous. Smart expiry selection is about matching the market's rhythm. In quiet, low volatility conditions, like what we often see during the Asian session, you need longer expiries. Give your trade room to develop. 30 minutes, an hour even. Let the market breathe. On the flip side, when volatility spikes, say, after the European Open or during Powell's testimony before Congress, shorter expiries make more sense. You want to capture those fast moves without overexposing yourself to choppy retracements. Another smart tactic we've seen traders use is expiry stacking. Let's say you're bullish on gold due to Middle East tensions driving safe haven flows. Instead of placing one single call option with a 30-minute expiry, you split your exposure. One call expires in 5 minutes, another in 15, and a third in 30. That way, if the move happens quickly, you lock in some profit early. If it takes time to develop, the later expiries are there to catch it. It's a layered approach, and in a complex market like this one, it makes sense. So where does this leave us? Digital options are no longer just binary bets. They're precision tools when used right. Hedging, straddles, expiry tactics. These aren't just fancy terms, they're survival strategies in today's volatile market. And let's not forget the platform you trade on matters too. If you're executing complex strategies, you need execution speed, tight spreads, and access to deep liquidity. That's where brokers like crystalballmarkets.com come in. They're giving traders the tools to apply these advanced strategies without the clunky interfaces or hidden fees you'll find elsewhere. If you're serious about taking your digital options trading to the next level, check them out. Because strategy means nothing without execution. That's it for today's deep dive. If you found value in this episode, be sure to subscribe and share it with your fellow traders. And remember, markets reward the prepared, not the lucky. I'm Sophia, and this has been Financial Market Insights for Traders. Until next time, trade smart, stay sharp, and keep evolving.